Europe's new car markets lost momentum in July, with many factors impacting the industry. But what does this mean for AltaVista 24 forecasts for the rest of 2022 and beyond?
So I'm being joined by AltaVista 24 senior data journalist Neil King. Neil is the man who puts together the registration pieces and the forecast articles for altavista24.com, and they are all well worth a read. So Neil, what's been happening in some of the key European markets in July?
Well, Phil, ultimately there was a general slowdown of momentum, unfortunately, in July. Germany and Italy merely edged forward. France pretty much engaged reverse, and Spain was essentially stuck in neutral. So the upshot is that, across the four continental markets at least, the volume in new car registrations averaged about 9% lower than I had expected for a month. Now, this may not sound ideal. Bear in mind, as I said, there was still some momentum. It just means the momentum was not as advanced as, let's say, myself and various industry observers would have expected. There was one mitigating factor which I think inevitably played a role, and that, of course, was the immense heat wave that engulfed the region, even as here in the UK during July. And I'm sure that had a detrimental impact on sort of new car market activity during the month. Obviously, very, very difficult to quantify, but nevertheless, I'm sure there's a slowdown. The interesting sort of exception really was the UK. I mean, obviously we suffered from the heat wave, maybe not as much as our sort of continental peers, but the UK actually performed exactly as I'd expected. No slowdown in activity, really just seems to have sort of ridden through any impact that the heat wave had quite nicely. Now, doesn't mean to say that there's a stark contrast between what's going on in the UK and elsewhere. I mean, this is obviously just the latest month's figures we're looking at. It's not, you don't identify a long-term trend clearly from just 1 month. But what I would say is that, I mean, this loss of momentum overall, is, I would say, slightly concerning. I like to attribute a lot of it to a heat wave because that doesn't point to a major new downward trend. But, it nevertheless follows, a reasonable performance in June when all markets really performed rather well. This was visible both in the sort of magnitude of the downturns in June weren't too severe compared to prior months, and even in the SAR, the seasonally adjusted annualized rate, which obviously we've recorded a video on, should anybody still be less familiar with this SAR terminology. But so I think, the upshot is that we had seen, let's say, confirmation of a recovery that had always been factored into my forecasts, and that was somewhat destabilized in July. Now, obviously, we've always assumed, and this has been widely reported, that any impact from the Ukraine war is diminishing. There have been several cases of, Skoda, for example, highlighting that they've now been able to get wiring harness supply back up and running. So, the signs were all positive. I think there's two areas of concern here. One, that recovery is slower than, let's say, was assumed. Two, that we've had obviously COVID-19 related restrictions in China, renewed lockdowns. That has had a slight impact on the supply chain as well. And beyond all of that, of course, now, given all the economic pressures that governments are facing and households are facing in terms of reduced financial budgets, that we're now starting to see potential signs of a slowdown in underlying demand. So, as I say, it's quite difficult to call because there are so many factors at play. But as it stands, I still assume that there will be an easing of the supply bottlenecks. But not surprisingly, given the situation as outlined, that we could well be seeing reduced demand, and accordingly, I have actually reduced the forecast down for all market. Just to give you a sense that, as you'll see here, we highlight the latest actual registration figures in black, and then we show the previous month's forecast and the latest forecast. And as you'll see across all markets, certainly for the continental four, France, Germany, Italy, and Spain, all came in below expectations, as I alluded to, and I have reduced the forecast accordingly. What I would say, of course, though, is even in the UK, the forecast was perfect for the July, but I mean, just to give you one example, obviously the Bank of England has just raised interest rates by 0.5 percentage points, and rather unexpectedly, they actually also stated that the UK is likely to fall into recession from the fourth quarter of this year. So not surprisingly, although July performed exactly as expected, I've also reduced the outlook for the UK.
Now, I know there's been some incentive changes in different markets and some other mitigating circumstances as well. So what impact are they having?
Yeah, I mean, quite a few changes in just recent, weeks, if not months. First of all, I think it's quite stark in France. Now, there was pronounced weakness in France, as I mentioned right at the very start, following a really, really strong performance in June. Now, part of this, believe it or not, was related to the fact that France had obviously announced a reduction of incentives for electric vehicles, which was, did happen at the end of June. And so not surprisingly, there was a bit of an uptick in demand overall, but especially for battery electric vehicles in the month. Their share increased, I think it's about 13% in June, whereas it's been 12% each on the months each side. So a bit of an uptick there, but at the end of June, the government then announced that the existing incentives would actually be extended until the end of the year. So that rush didn't necessarily need to happen, but it obviously did. But that does mean that that's slightly positive for the end of this year. And I've actually factored in, you can see it here, I've factored in a slight uptick in, registrations forecast for France this year. And if you look at the other view just quickly, you'll see here that whereby I have trimmed the forecast for the coming months, I've really sort of been very gentle when it comes to November, December because of those incentive changes. So it's incredibly challenging because obviously we're not purely just considering demand translating into registrations. We're also considering what's happening to the improvement in supply. So put all those factors at play, quantifying this is incredibly difficult, and I have to be honest. But nevertheless, those are the latest assumptions, and it's quite a sort of unique case in France. But having said that, Germany has undergone something similar. Obviously, as we've discussed ourselves in articles, including the usual excellent roundup our colleague Rebecca Scheid does on Germany every month. The German government has announced tax changes whereby it's actually PEVs, plug-in hybrids, will no longer be eligible for incentives as of 2023, and BEVs that are currently entitled to a €6,000 subsidy if they're priced below €40,000, that will reduce to €4,500 next year, and those that are priced over €40,000 will only be entitled to an incentive of €3,000. So again, it's although they're not being completely withdrawn, and you have to, even if the order's placed now, the car has to be delivered, and as we know in many cases that can take 12 months if not longer. But the fact of the matter is, I have also, as in France, factored that into a forecast, and again been, let's say, more gentle with the trimming that I've applied to November and December in Germany.
So what about Italy? Because I know that they've, in contrast to other markets, reintroduced incentives.
Yes, in a nutshell, the short form is, yeah, they certainly have. There was, let's say, a lot of procrastination among Italian consumers because they knew that the plans were afoot to reintroduce incentives, but the timing was never clear. But these were ultimately reinstated late in May on the 25th. And, we have seen, a slight improvement in registrations in Italy, especially obviously for battery electric vehicles, not surprisingly. But even then, this subtle improvement is slightly below expectations. The other point I would make is that, as far as the incentives are concerned, they've actually already been exhausted for vehicles which have CO2 emissions in the range of 61 to 135 grams per kilometre. That range is actually where the greatest number of requests are concentrated. Obviously, that's more so for plug-in hybrids and hybrids than it is for BEVs, understandably. But the other issue, of course, is in Italy that the incentives are only available for private buyers. Much to the chagrin of the Italian Car Makers Association, ANFIA, for example. So there is an element of uptick in Italy from that, but it is very, very, very limited. And, as I said earlier, Italy's not performed especially well in July and is essentially suffering the same fate as everywhere else. And I guess the other market that we have to consider when it comes to incentives, of course, is the UK, which obviously, sort of unbeknown, or rather unexpectedly, just pulled the plug on the PICG, the plug-in car grant, which had offered an incentive up to £1,500 off the cost of a new electric car. And not surprisingly, I'd already factored that reduction into a forecast. But as I alluded to earlier, really, it's the economic pressures, the spiralling inflation, rapidly rising interest rates, and really that fear of recession, and just that fear of recession alone will be enough to make it almost a self-fulfilling prophecy, whereby consumer confidence will drop, even so it will fuel itself. And so all of that is kind of considered in the forecast.
So what's the upshot then for the rest of this year and going forwards into the next few years?
Yeah. I think the core point, I made earlier is that, not surprisingly, I've reduced the forecast down for all markets again, but this is the first time that I'm now seeing a contraction in all 5 of the major European markets this year. They're obviously of differing magnitudes. France, Italy and Spain are all forecast to contract by about, certainly more than 5% year on year, with much more modest declines in Germany and the UK. But you add all that together. As you can see here, I'm showing clearly this is the forecast for 2022 for each market, lower than where we were in 2021. But if you add all that together, then the entire European market, so obviously the EU, the UK, the EFTA markets of Iceland, Norway and Switzerland, that has been really downgraded forecast-wise by more than 200,000 units just this month. And the whole region, I'm now predicting to essentially fall, unfortunately, for a 3rd consecutive year, which would have been unfathomable. Even when COVID-19 first hit, if anybody had said that the market will now fall for 3 years, that nobody would have foreseen that. But between not just COVID and recovery from it, but obviously between that, the semiconductor shortages, which we've discussed at length, and then obviously, unfortunately, the war in Ukraine as well. This is this unfortunate situation we're in, and across the whole industry. Just to add to that, I'm saying the whole European market now will be down about 3.5%, so that's less than 11.4 million units. And to really give that perspective, that's 28% down on the pre-pandemic level in 2019. And myself, as in Autovista 24, not really expecting the market to return to sort of pre-pandemic levels until the next decade. At the moment, I'm saying 2032. But as it stands, there's no guarantee that will happen. We're still kind of looking at a forecast that is largely based on supply, but I think that whole momentum is slowly shifting, whereby the supply is slowly improving. But as I said earlier, I think we are starting to now really start to see the signs of the first impact of a sort of a weakness of underlying demand. And that is translated here in a forecast for each market and across the board. at last obviously have an element of recovery factored in for 2023, clearly because we have, let's say, some catch up. You know, there'll still be countless orders of cars that will not be fulfilled this year, still will be, you know, let's say, delayed into next year, and an element about also into 2024, and that's widely reported, of course. The whole industry is still talking about semiconductor issues persisting into 2024. And then beyond that, a slight decline in 2025, but that's largely because of the, you know, the emissions targets that will come in 2025 as part of the Fit for 55 package, which I know you yourself have widely covered. So that's where we stand. And then longer term beyond that, really, we're just seeing a situation whereby sort of recovery or improvement again from 26 to 29, and almost like a 5-year pattern of then a dip in 30 as manufacturers register what they can in the years of 2024, 2029, 2034 ahead of new emissions targets, or the ban on sales of petrol and diesel cars, certainly new cars in the UK in 2030. So as you know, you're starting to see this this sort of general trend of sort of a rise in between, as we're seeing in the forthcoming years, and that replicated through to 2030 and then again through to 2035. But even then, you know, long term, there are countless questions.
Neil, thank you very much. It's been really informative to find out a bit more about forecasting.
It's been an absolute pleasure. Great to see you, especially in person, Phil, and I look forward to seeing you again soon.
Excellent. And don't forget, you can check out more of Neil's great content on autovista24.com. While you're there, make sure to sign up to our daily email, which brings you the latest news, analytics, and data-driven articles direct to your inbox every morning. You can also check out the Autovista 24 podcast on Apple, Spotify, Google, and Amazon Music. And don't forget to like and subscribe to our YouTube channel so you never miss one of our informative videos again. Thanks for watching.